Hello, everyone. Roger Knecht, president of Universal Accounting Center. I'm with Erin from Profit First Professionals. And again, we're going to be speaking about things related to the business, particularly this time, navigating seasonality. It's something I think every business experience. We all have our ebbs and flows. We have our peak seasons, our lulls. So what we're going to do here is, Erin, you're going to help us navigate that a little bit more effectively. Isn't that right?
Yeah, and I'm going to be honest with you. It's funny because we talk to a lot of business owners, and they kind of can get this thought in their mind where, oh, if I have Profit First in place, then I'm going to eliminate any potential outside problems that could come my way from a cash flow standpoint. It's the saving grace of all saving graces, right, when it comes to money. But the truth of the matter is Profit First is a cash management system. You are still susceptible to peaks and pits when it comes to the flow of our money. And the power of Profit First is in your ability to be proactive, to identify them before they become problematic. But in these peaks and pits, what we find is that a lot of business owners, whether you're implementing Profit First or not, it's a easy place for us to kind of revert back into our old ways, to go into this panic mode. You might find yourself way more susceptible to diving into your credit line, to utilizing credit cards, to taking out that loan. You might even just stop paying yourself altogether because it's too scary, right? So the first thing I want to do today is encourage you that Profit First, while it does not solve all of the cash flow problems, it will definitely impact your cash management and allow you to navigate around it at a much higher degree in a much more proactive way. And even in this season, do not fret, right? We are, today my goal is to talk about ways to navigate around it. But before I do that, I just want to give a friendly reminder to everybody not to fall for the survival trap.
So I'm going to jump in right here as you're getting started, and I want to share two things. One, I think what you're sharing is very important because it's an emotional part that the business owner experiences. It's very emotional, and when you're running a company, it's one of those things that you're intimately involved in because we can raise our hands. There's many business owners that go so far as to not taking payroll or payment, and it's that sacrifice that we're doing to keep the business alive. And one of the things we do teach, and it's a prominent thing, is cash flow, cash flow, cash flow. So I'm excited to have this conversation with you as to the Profit First approach to navigating this. So continue, please.
Yeah. So one of the ways that we navigate around it, actually, if you are familiar with the book, you may have heard this terminology before. It's called the drip account. You can find out more about it on page 153 of the book. But the drip account is a really awesome tool. So in a lot of businesses, especially the accounting bookkeeping world, we experience retainers. We might have project-based income where we get chunks of money up front that require extended time and extended resources. But what happens in this relationship is I get paid for the project up front, or I get paid for an annual relationship when actually I'm going to be doing work throughout the entire year. But what I'll do in most situations is I got paid up front, woo, payday. I'm taking my family out to dinner. It feels really good. May is going to look great. June's going to look great. What happens if we use all that money when we first get that income and we still have to provide for the resources that income is intended for later in the year, but we've taken that full dollar value amount and we've already allocated it to our owners pay, our profit, our tax and operating expenses. It looks real nice, but it's not very comfortable later. So how do we navigate around project-based relationships or annual retainers or just even deposits in general? Instead of us treating those like true income, one of the ways that we navigate around and we prepare for our use of the resources, I guess you could say, is by opening a separate drip account. We open an account strategically to hold these deposits, to hold this income for when we're truly going to be utilizing the resources that this money is responsible for facilitating. So when you get money in, your money will go directly into your drip account. And this really does only apply to any relationship that is extended. And we consider that to be 2 months or beyond. If it's just a one-time payment for a relationship that'll take you a month, you can count that as your income for the month and just allocate and deposit as you typically do. But if the relationship is 2 months or greater, deposit it into your drip account. Deposit it into your drip account. And as you utilize the resources, strategically shift them and allocate them as they are needed. So one of the things I want to show you is just how that can look. You know, what we want to do at first is, instead of saying, hey, listen, okay, well, you know, just put the money in your drip account and then put it in your income account, you know, it's not a big guessing game. It's actually a little bit of math. It's a little bit of math. Some calculation is involved. So the first thing that we'll do is we'll ask what your allocation rhythm looks like. Rhythm is super important, and this is no objection to that. So when you have money come in, how often are you allocating? Are you allocating once a week? Are you allocating once a month? Are you allocating on the 10th and 25th? We want to determine what the dollar value amount is going to be for that allocation, right? So when you have money come in, snooze, I don't know if you guys can see that, but snooze. When you have money come in, you know, let's say you got paid for a project, it was $12,000, and you're going to do a cleanup. It's a really heavy duty cleanup. It's likely going to take about 4 months. What I encourage you to do is document the start, document the amount of income it's going to be in total, and document the time frame in which the responsibility is going to be there for the project, right? Once you've determined that, then you can take and identify the time frame or the allocation number that you'll be utilizing. So for this first example, you can see here on January 1st, I got a deposit of $12,000. I know that relationship is going to be approximately 4 months. If I take that $12,000 and I just have a glorious spending spree, you know, you're going to end up being wasteful, considering Parkinson's law. So I'm going to deposit that $12,000 into my drip account. And then I'm going to say, hey, listen, that $12,000 is good for 4 months. That means if I divide my $12,000 in income by 4 months, that's about $3,000 that I'm going to be moving into my income account a month. But I'm allocating on the 10th and 25th. So my regular allocation is going to be $1,500, right? So I've been making transfers to my income account from my drip account for the last 4 months. It's now June, so I don't have any allocations that I'm going to be making for that resource or for that project, because I've already facilitated the work and the service is complete. But then on that same day, I had kind of a same relationship. I had $12,000 come in for a yearly relationship. And yeah, again, I could deposit that into my income account, but it's not going to be realistic, as I need the resources to facilitate the relationship. So I'm going to take into account, again, what does that look like? $1,000 a month. Every allocation period is going to be $500, right? As I determine exactly what that looks like, I can then identify and see, okay, every allocation period, the amount for my drip account is going to be $700. Actually, it should be $600, math error in here, right? Real life. I'm going to allocate that into my income account on a regular allocation structure. And I'm going to then flow it to my profit, my owner's pay, my tax, and operating expenses, so that I know that throughout the year, I have consistency in my income, which then allows me to have consistency in my decision making and peace of mind as I work through the peaks and flows of my cash flow.
You know, one of the things that I think is very important here is, as an accounting professional, they can simply relate, because so often, as you were describing in this example, there's this back work that comes from a client that needs to be done, and you're able to charge it hourly. You can literally say, I'm just going to charge a particular rate, and we're just going to start working through this, and the client has no idea what this is going to cost. You don't know where this is going to end. And honestly, because you're being paid hourly, what's the motivation to get it done quickly? You're getting paid this hourly rate. So in your example, you did a great job of saying, for the $12,000 flat fee, this agreed upon amount, the client can have the peace of mind of knowing that this is the amount it's going to cost to get it done. And I can see the value in that. And as a client, I'm going to say, you know what, let's lock it in. Let's get that price point. But what you do is maybe you're quoting 15,000 for the project, but you're saying, if you give me cash up front and pay me in advance, I'll take $3,000 off of it. So instead of paying me, let's say over the 4 months, a different amount up to that 15,000, I'm just going to charge that 12,000 upfront, paid in full. But you're right. You don't want to allocate this now or go spend it month one. You've got two things going on. You're going to amortize and drip this over the months that it's going to take that you forecasted. But now you're motivated, because the faster you can get this done, the more you make per hour. And so that $12,000 is either going to be distributed over 100 hours, 500 hours, 1,000 hours. It's $12,000. How are you going to make that get the most bang for its buck, if you will? And I love how you're allocating this, because based on the percentages, it then flows through to the taxes and the income. This is great. This is wonderful. I like the analogy.
I'm glad. So this is a helpful tool, again, and for you to be able to be proactive. There's also a lot to be said. I know some people are so focused on being proactive, they don't spend any time looking at what has happened before. But I know for sure that businesses experience seasonality. And so I kind of want to take the drip account, just the general concept of putting money aside intentionally and flowing it through a season of time for which our resources are necessary, right? And build on that. What happens when a business, accounting and bookkeeping, what happens when a business has an extremely skewed heavy season? For accountants and bookkeepers, holy tax season, right? January through April, you're rolling in the dough. It feels real nice. But come September, you're scraping. It gets scary. And that's where that survival trap comes into play. That's where our credit lines come into play. How do we navigate around seasonality? So one of the things I want to do, and one of the things I want to share with you, is how important a historical perspective can be in creating a cash projection and a plan with our finances. We can take our profit first implementation and make it extremely strong by looking back a little bit. So I want to ask you a question. When is your heavy season? You might not have an extreme heavy season like, an accountant, but you have a heavy season. Do you know what it looks like? What time frame does it usually fit into? How much excess in income do you experience at that point? What are your responsibilities to, because of course, as your income increases, it's likely that your expenses will increase to some degree, right, to produce. What does that look like? What is left over, if you will, in that season, right? Knowing exactly what that looks like can help us answer and navigate around the slow season. So we're going to ask the same questions about that. When's your slow season, right? When are you going to provide for that slow season? How do you provide for that slow season if it's not straight out of your heavy season? Because what I've seen a lot with business owners, and I hope everybody is the exception to this, right? Everybody that is listening is the exception to this. But a lot of times when we get to that slow season, we are utilizing all the resources from our previous heavy season, right, to pay off our last slow season. So in this current season of our seasonal lull, now I'm, it's okay. I'll just put it on the credit card. It's okay. I just won't pay myself this one time. It's okay. I'll take out a loan, or, maybe I'll just kind of put my head to the ground, try and sell, even if it's outside of my ideal client or service, right? And then come heavy season again, we are panicked because now we can't afford to get that season started. So we're incurring more debt. And in the heavy season, we're just going to keep paying back what we already incurred in debt so that we can keep our head afloat, or we'll pay ourselves back because we didn't pay ourselves the entire time. And we're constantly playing catch up. We're constantly playing catch up. And this is one of the probably the most dangerous pieces of what I've seen in seasonality and what happens with entrepreneurs as it pertains to this subject, because it's really difficult for us to break that cycle. And it can often take a lot of time and diligence, and it's not an easy thing to do when we don't have systems in place to help us get out of it. So the first thing I encourage you to do is identify it. Even if you're not extremely susceptible or taking out debt or anything like that, this is a great opportunity for you to start being proactive in this piece of things. Because as you get bigger, as the ball gets rolling, so do the responsibilities. We want to make sure that we're ahead of those. So just document. Start documenting what that relationship looks like for you. Then once we do that, what we'll talk about is a seasonal stability account. If you can start to identify where your income is in surplus, then we can navigate around cash influxes and cash lulls in a way that we create our own credit lines, in a way that we have systematized everything so that we can see the true flow of things. This isn't exactly what you have to do, but this is a sample of a real estate business and kind of what their season looks like. I would encourage you to add dollar value amounts in here so you can truly see, right? But it's helpful for us to be able to really truly comprehend how our business functions and flows so that we can address the need at a deeper level and not just bounce around like a buoy in the waves.
Well, there's one thing that I think is important that I'm hearing you say, and it's rather than taking the surplus and going into the deficit and using the next surplus that we're hoping comes pay for that debt, we're going to use the surplus to manage the growth in the downturn that we may experience. And hopefully that downturn isn't any larger than the surplus was. And therefore we move into that next surplus, having never gone on into a deficit. That's what I'm hearing you say. And it's definitely a lot less stressful to manage that way, is to be not looking forward to the future, hoping that that's going to be a success that pays your way out of the hole, that pit you're describing, but rather we're taking the successes we've had to manage us through that problem, through that situation. Now, the other thing I would also throw in here from an accounting perspective is there is a seasonality to the accounting business. And as you're in business, you'll experience that. But one of the things that you can do is manage it so that you are, as you described, your own bank. You're creating your own line of credit. And I think that's one of the powerful things, because obviously that's the lesser interest that you're paying and such, but it puts you in greater control of your own business. You're in more in control of your own destiny. And the other thing I would also add to this is that as you grow your business, it's possible that as a pendulum, the higher the high, the lower the lows. And so if you have a very, very growing business, you also run the risk of line of credits and such being necessary to kind of weather that growth pit that you may experience. And that's going to be a bigger one. And so it's just the swing of the pendulum. The higher the highs, the lower the lows, in other words. So
Absolutely.
I'm liking this. And I like that graph there that you're sharing.
Yeah. Well, and I do want to encourage you too that, revenue is no exception. We just had $100 million company reach out to us last week and said, somebody warned me about this, but it fell on a deaf ear. Businesses go through experiences that are very similar, regardless of revenue range, regardless of success or status or how many employees they have.
These are all very rare.
Yeah, exactly. It's all figures.
Uh-huh.
It's all relative. And the only way to navigate around that is to have systems and processes in place to avoid that. And when's the best time to have a system? Before you need it. So here is us encouraging and showing ways that you can take this process and really streamline it so that should you find yourself in a situation where this is something that you're going to experience, you have the ability to work around it, or you have another layer of cash freedom that you wouldn't have had before should you never experience an extreme situation, right? Let's cheers to that. That's the dream, but
Yep.
it doesn't always work like that. So I want to talk a little bit about planning for seasonality. So when we are talking about a seasonal period, again, we're talking about a time and place where you are going to see an increase or a surplus in your cash that is relative to a specific time. In that time frame, this might be a more difficult thing to navigate or calculate, but I do encourage you to take some time and do some comparables. What does that look like for your business? You can use percentage points. You can do dollar value amounts. We have we have profit first professionals that what they'll do is, you know, in their heavy season, they'll just continue to operate as they do, and whatever's left in their operating expense account, they'll put that into their seasonal stability account, you know, and that's okay. But Parkinson's law is real, right? If we have excess in our operating expense account, it's very likely that we're going to have excess in our spending, unless there's accountability and discipline. So what I do encourage is to do a little bit of a historical evaluation and determine what the surplus typically looks like. It might be $1,000, $3,000. It'll likely vary by month as well, right? You might see a consistent pattern as you evaluate a couple years back, right? Mm-hmm. Think about it though, and don't be afraid to start a little small or start a little big. You can, you know, whatever you're most comfortable with, just start, right? You can always adjust. This account isn't a blood oath. It is, however, an opportunity for you to have more insight into your business and your decision-making process. So in this example, the business went through an evaluation. They had money come in at the end of December. You know, let's pretend that that was their heavy season. December was when their heavy season really starts, right? At the end of December, they had an influx of cash that they determined to be approximately $3,000, you know, and you can round, you can pick a dollar percent amount, a percentage point, whatever it looks like. They took $3,000 and they put that aside and they stuck it into their seasonal stability account or your drip account. You know, you can label it, it can have the same purpose. Yeah. We want to track it. We want to track it realistically and what it's meant for, right? And the difference with the seasonal stability account is that we are not going to flow this through into every month. Okay, we are going to identify what our heavy season looks like. And in this example, it's, you know, they started making allocations for their heavy season come December. January, February, March, April is when they were making their allocations. They put the money aside. That was their nut, if you will. Their slow season doesn't start till September. So you best believe that we're going to let this money chill in here until their slow season comes around. So here's one thing to note. A drip account might be more beneficial to have as a checking account because money's going to be flowing in and out of it more consistently. If you have something strategic like a seasonal stability account, find the bank that has the best interest rates. You know, pick a savings account where you can make a couple pennies off of your money, right? Let it sit, let it build. And then when it's time, when you start to really feel that lull in your cash, that deficit of resources, that's when we'll start to flow it in. But I don't want you to just wait until you're a little uncomfortable and put the money in. I want you to plan. I want you to have parameters in place prior to allocating, because it's important that we aren't emotional in this. Okay? We have set up a structure so that we can see exactly when our money is necessary to create more stability and consistency in our cash flow. So in this example, their slow season is September, October, November. Notice how that's right before their heavy season hits. You know, it never kind of like, a lot of businesses, there's a startup cost involved. Landscapers, it goes from winter to spring. Like there's no in between. They don't do a lot in winter. That's they experience a serious cash freeze in that time frame. Mm-hmm. To go from nothing to your heaviest season come spring, that's terrifying. And again, that's where most people are leaning on their credit lines, right? Utilizing the stability account, don't just allocate and determine exactly what that looks like based on the number of allocations. Determine what your startup investment will be in your season. Every business has one. How many employees are you going to have on hand? Do you know what the initial cost is to make sure that all of your landscaping equipment is up and running? You know, what are the chances if something's doormat for the winter that it'll be gone? Of course, we want to prepare for that in advance, but what does that typical surge of money, if you need, or surge of resources look like? Because most businesses have them. Put that money aside. Have that be your seasonal startup buffer. Have that money be prepared for you as you get started in that season. And then whatever the difference is, then you can allocate based on what your determined flow is in that season. Does that make sense?
Does. Yeah. One of the things that I think is important here is you're giving, I believe, the business owner some context to look into the long term, not just the short term. You're helping them realize that there will be these seasonalities or these challenges. And you do need to not just depend upon your line of credit, but you should be building up your own bank account. And this is where I see people using the traditional CDs or money markets, or maybe they get into other things that they find to be a little bit more worthy of investment. But the point is it's not necessarily this overly liquid money that they're trying to run the business with. This is where you're trying to now build up this fund that will allow you to get through those patches. And one of the things that's important is you're addressing the whole point of the line of credit not being the only course of action. You're giving them the chance to actually run their business intelligently. And rather than take everything out of it as it's being profitable, it's now empowering the business to be a self-sustaining entity. So I'm just going to include one thing here that I actually do with our clients, and it's basically teaching them that just like every employee within the company, owner included, you need to be treating the business as an employee. And so with your company, it's making money. And just like you have a savings account, you and your spouse have a savings account and you're saving money. This is, in essence, one of the savings accounts that the company has for its future and for its well-being. And so if you look at it as you are the steward of your business, and as the steward, you're making decisions for this company that in reality can't make these decisions on its own. So you as the president, the owner, are that steward making these decisions. Now all of a sudden you're recognizing that like you have a 401k and like you have an investment plan and like you have a savings account for when the washer and dryer go out or when you need a new heater or when you want to buy a new car or put in a new deck. All these things are investments in your property or in your lifestyle status. Well, the same is true for the business. Are you going to invest in a new software program that helps streamline the business process? Are you going to hire a new employee? Are you going to buy a new desk and chair? Are you going to buy a new computer? Well, the seasonality is also an element of this. How are you going to handle payroll when you get into that lull? Well, these things are accomplished by, just like you run your personal life, you within the business as a steward set up these accounts as a drip account, for example, to actually manage life. Life's going to happen. How are you going to handle that with the business? And that's what we're talking about.
Yeah, absolutely. And the cool thing about this is it does function in the same way that a drip account does. So in these seasonal periods, you'll deposit that surplus, that excess, into a strategic account, and then it'll flow into your income as you've determined that your allocations will flow, right? But even more than that, you might find that you end your slow season at zero in this account. Cue heavy season. Now, instead of us waiting for the stars to align, we have things in place or a structure in place so that we can capitalize again on that heavy season and rebuild that account so that we are no longer susceptible to the ups and downs of seasonality or the market or anything else, right? Now we have things in place where we can be consistent in our cash flow. We can be consistent in our investments. We can be consistent in our vision, and our decision-making process is now under control, right? I think that one of the biggest things that we often forget is that as business owners, we make decisions so often on our cash, right? Our panic modes and our the scary moments often are around our cash. When you have a cash management system in place and you've structured it in a way to avoid any peaks and valleys in our cash, right? Now guess what you're going to be navigating around? Business problems. Your cash and things are in place so that now you can talk about, how do I want to take this to the next level? Where is my vision now? How can I support the stage 3, and what I want to do? How can I talk about retirement or passing this on to the next generation? Now you're talking about bigger picture things, because we aren't just working through the day-to-day and scrambling to survive. And that's where the power and the freedom come. So the flow is important still. No matter what, even in these heavy seasons, these slow seasons, we want to put money into profit. We want to put money into our owner's pay. We want to make sure we have that nut for the tax man. And our operating expenses will likely still be consistent. The excess, though, we're going to be really strategic and capitalizing on it because we have a system in place to do so.
Yeah, what I'm hearing you describe here is something that we do with our clients where we break up the evolution, the emotional experience that an owner has while starting and running and operating a successful business. And it's first, they go through a job status. They're basically in a job where they're involved with the day-to-day roles and interactions with the customer. And it's a day-to-day experience that they're having. But what we're trying to do is get them to then a lifestyle status where, as the owner of the company, they're experiencing something different than if they were to go work elsewhere. And they have some liberties and freedoms that they wouldn't have otherwise because they are, in fact, the owner. But that's really not the pinnacle of what we're trying to do. Is we want to get that owner to a status of ownership where they're actually an owner, something like what you would maybe see on Shark Tank, where you see an owner of a business with shareholdings, but they're not involved with the company. They're more visionary. They're more instrumental. Well, imagine implementing these strategies, these very important principles to move you from just being involved as a job in the day-to-day operations of the business to now elevate yourself to that lifestyle situation, and then ultimately that owner status. That's beautiful. And these are emotional things, but they're practical because of strategies like this. So this is wonderful.
Yeah. Well, and this is where it gets fun, but I do want to encourage you, because this might seem like it's 1,000 worlds away, right? You might be still just working through the basics of cash flow and getting a system in place to navigate around minor frustrations versus, forget about seasonality, right? Every step, I've said this probably 600 times, even in these webinars, every step in the right direction is a solid step in the right direction. You might not have everything in place to be able to completely support your own slow season, but even if in this next one coming up, if you can have $100 aside that you aren't really reliant on a credit card for, whatever, even if you still use your credit card, but you've set aside $100 and you were able to relieve yourself of that $100, you made a solid step in the right direction. Keep that going. Rome was not built in a day. I don't expect anybody to experience the true benefit or be able to implement this in full force straight out the gate, right? And if you are, I want to let you know, you should pat yourself on the back because you're the exception to the rule. Be persistent, be diligent. And it really, truly, it doesn't matter how long it takes you to get there. It matters that you keep going, right? You'll find that before you know it, whether it's 10 years down the road or not, you'll blink and be like, yeah, that happened overnight, right? It's really all perspective, but the power is in persistence and consistency.
It's slow and steady that wins the race, right? So with your example here, one of the things that I would share is, you're right. There's the big picture. There's the ideal. What does it look like? What am I striving for? What am I excited to do? And then let's take the baby steps to move in that direction. And I'll just share a personal experience that I think relates to this. We met years and years ago with a financial planner. And as we spoke with our financial planner, we were talking about strategies for us for our long term, the ultimate being the retirement. And he said something to my wife that was just a shock. He specifically said that what we needed to do is build an account that would in essence be $10,000, and it was intended to cover any let's say, tragedies that could occur that could impact us over the next 3 months so that we could actually have cash to cover our living expenses and such. And my point with bringing this up is when she heard that she was supposed to save and have an account of $10,000, she was flabbergasted. I think at the time we probably had $1,000 in the account, and it could take like a water heater or a new set of tires on the car that could really wipe something like that out. And she was just taken back that she had to set aside over the coming months that money. But she did. She committed to doing it because the financial planner knew that if he had a client that would do that one simple step of saving 3-4 months slush fund, it would identify that client as someone he could work with to implement all the other strategies necessary to prepare for retirement. And so we were much younger. We didn't have all of our children at the time. And here she was just daunted by this task. And she did it. Well, I'm going to tell you right now that for my wife, that $10,000 threshold is her proverbial zero. that account doesn't go below that. And it's simply because of the fact that that is where her comfort level is. And that's something that she has intentionally identified for herself as being, this is our new zero. And when you as a business owner hear this message and you're like, I want to get there, that $100 that you described, Erin, as being that first step, that could be huge. Rather than taking that $100 and going down to Costco and buying something and leaving and 2 weeks later wonder, what did we ever do with that $100? Leave it in the company, build up that account, go from $100 to $500 to $1,000 to $5,000 to $10,000. And then all of a sudden as a business, you're going to feel like you have something that you can be proud of, that you're running, that's not running you. And it's all because of these principles that you're teaching from Profit First.
Yeah, it's exciting. And, you know, it really is. It's so much bigger than just today. You know, just remember that every time you go to swipe your card, every time you feel like you are so overwhelmed, it's so much more than just today. Tomorrow's going to be another opportunity. Tomorrow's going to be another chance to succeed, a chance to fail. You know, there's going to be another hiccup or a glory day, you know, one day at a time, one decision at a time. If you don't have support or somebody on your team to help guide you through these things, call somebody, you know, find an accountability partner. Of course, obviously, profitfirstprofessionals.com, you can find one or be one. But I encourage you, you know, the ones that are succeeding in this are the ones that have people in their corner to talk to about these things. They have people in their corner to yield insight and perspective, and they aren't going it alone. So take those steps, but as you grow and as you feel like you're in a place where you're really ready to hit the next level, go with it with somebody else. You know, what is it? You want to go far, or if you want to go fast, go alone. If you want to go far, go with, you know, pick a partner, right? No, and we're huge advocates and believers in that, especially when it comes to our money.
So one of the things that I'd like to really stress for everyone listening is definitely these principles apply to you as the owner of a company. Your business is very much affected by these principles, and you can be running your business more intelligently, more purposefully if you implement these strategies in your company. But more importantly, as a Profit First professional, you can actually become now the person who takes this to your client base, and you can be paid very handsomely as a consultant. In fact, a Profit First professional providing these services to your clients to help them as they navigate the same thing you're experiencing as a business owner. Now you're helping them. You're being that advocate. You're being that teacher, that consultant, that advisor, and you're being paid for your ability to help them implement these strategies and run their businesses more profitably. So take Erin's advice, not only apply these principles in your own company, but at the same time become proficient and confident enough with them that you can then actually offer this as a service to your client base and help them become Profit First implementers. They then are benefiting from these principles in their own companies. And whether it be like you shared earlier, that $100 million revenue business, or someone that's perhaps $100,000 in revenue, they as a company can benefit from these principles. So I'm going to include down below in the description here some information regarding how you also can become a Profit First professional, but I'm also going to include some information regarding the book Profit First and the other called In the Black, which talks about cash flow, that I think is going to be very appropriate for this. So Erin, any other final thoughts that you'd like to share?
No, just grateful for the time, Roger. I appreciate it. And, you know, we're excited to share and be able to bring a little bit more insight. Hopefully the small steps really do change what your future looks like and what generations to come look like.
That's right. Well, it's all about the mission of eradicating entrepreneurial poverty. So let's help each other, and it's holding one another accountable, and more importantly, implementing proven systems and strategies to run our businesses more practically. So with that in mind, thank you everyone for listening in. And remember this, if it's about accounting, it's universal. Take care.
Thanks, Roger.
You bet.